Well, good evening. Good evening. Good evening. First of all, can you hear me? If you can hear me, why don't you type something in the answer? Or if you cannot hear me, then maybe you want to type something in the chat box in the questions. Okay, looks like you guys can hear me. Great, great, great. Beautiful. We still have people logging on. This is the first time that we've ever done really anything like this, and about half the people that have registered are already on. It looks like the other half are joining us, and a lot of people aren't familiar with this type of webinar, the system. It's not something we've done before. I talked to a lot of people that weren't sure how to even log on. So we're going to give everyone a few more minutes, but welcome to our home. I'm working out of my home like most of Americans are working out of their home today, and we're no different. Now, we opened up our office, I think it was a month ago, kind of officially, where we were really planning on going back in 5 days a week and having, part-time staff there and part-time staff at home. And because of some issues and because of the climbing number of cases and so on, we've really scaled that back. So we are in the office now really 2 to 3 days a week. If I'm there, then I need someone there to help me. So one or two of my staff members will be there. And if I'm not there, then there's no reason for anybody to be there. So if you have a reason to come by the office, you want to call us first and just make sure that that someone is going to be there. And again, I'll talk for a few minutes while we let people log on. We had over 200 people register for this event. Currently, I have well over 100 that have signed on. Just want to make sure that they don't miss anything. This is for those of you that have ever run a webinar before, I've got multiple things going on at the same time. I've got a dashboard that feels like I'm kind of running a small spaceship. I've got drop-down menus everywhere, and so if I go through this webinar, as I try to flip our PowerPoint, if it looks like I'm a little discombobulated, there's probably a good reason for that. Normally I have people helping, but at home I don't. So let me make sure you guys can see my screen. That would probably be a good idea. Can you guys see my screen? Should say, can a virus actually derail your retirement? Can you guys see that? Okay, perfect, perfect. Looks like everyone can see, so awesome, good. So we still have quite a few people joining. Let me just start in by kind of giving you an idea as to what prompted this, what the goal is. We scheduled this as a questions and answer. My goal, my focus was really to have more of a Q&A session than it was to have a presentation. So we put together a 30-minute kind of a preliminary presentation for me to give you some of my thoughts, and then we're going to take as long as we need to do questions and answers. This will be recorded, so if I don't get to your question with everybody here, I may not be able to get to every question. Then in fact it will be recorded, and and then we can go ahead and you can watch it again. Or if you don't have time to watch all the questions, if you only scheduled yourself for half an hour, as we told you, then you can always watch this later. But yeah, it got scheduled for a half hour, and if you know me well enough, it takes me a half hour to say bless you if you sneeze. So I have never been accused of being short-winded. I'd rather say too much and explain too much than say too little. So we're gonna talk a little bit, and really the primary purpose of this was for my clients. And if you're a client of ours, you know how much I appreciate your business. I thank you for your business. I thank you for your trust. We also have a lot of guests on here. If you're a guest, welcome. Look forward to having you. If you have any questions about anything that we talk about, you can feel free to type it in. But there's going to be a survey that you're all going to get when either you leave the seminar, whether you have to go early or whether or not we're done. And when you leave the seminar, there's going to be a few questions. I think there's 5 questions. And one of those questions is whether you want to schedule a 15-minute call with me to answer your question maybe more specifically. So clients, you can talk to me anytime. Guests, you're welcome to call and schedule a quick 15-minute call with me about anything that you've heard. And the whole gist of what I wanted to kind of talk about is what happens in a worst case scenario. The fact is that we don't know what the worst case scenario is going to be, and that makes it really, really difficult. So what if we were to kind of project and compare to some of the calamities we've had in the past, and kind of take what's going on today and look at worst case scenario and what do we do? How do we protect ourselves? And that's what we're going to talk about. We're going to talk about what could be worst case scenario, and then we're going to talk about what can you do to protect yourself, or if you want to be opportunistic, what can you do to capitalize on it? And again, I'm going to talk for about 30 minutes, and then we're going to open it up for questions. So type your questions in as we go, and then I will take your questions when we're done. And then we'll go ahead and I'll read out the questions at that point. Now, where this material came from is research that I've done for my book. Some of you know that I have a book that was supposed to come out in August. And this book is called Outliving Your Money, How to Protect Your Retirement Savings. And so what we talk about in this book is the things you don't know about retirement that can hurt you. You know what they say, and that is that, what you don't know can't hurt you, but we know that that's not true. So I've got 11 chapters in this book about Social Security and Medicare and investing for the right phase of life, Social Security, and so on, about what you don't know about these different topics that you need to know so you can be going in the right direction as you start to prepare or navigate through retirement. And this book has been done for a long time. It took me 2 years to write. It was, I want to say it was April, maybe even March or April, where it was done. And for those of you that have written the book, once it's done, it's done. I mean, and then it's going to go through the process, and it's going to take 6 months to come out. So it's scheduled to come out August 8th, and the coronavirus hit. And in early May, I called the publisher and I said, look, I know we're way beyond that time, but I can't have a book come out August 8th about financial planning, and not have anything in there about COVID. Please, please, please let me write another chapter about COVID. So they did. So I got them to let me write an afterwards, which is just another chapter. But what that chapter is it's called a foretaste of the aftermath of COVID. And so for those of you that have written the book before, you know that the hardest part of writing a book is not the writing, it's all the research. So I did as much research as humanly possible and with regards to COVID and what the aftermath could be, and I put that all in a chapter. As a matter of fact, I'm going to read a segment of my book as part of this webinar later, and you'll see that. But that book is now scheduled to come out. It's been done. It's now scheduled to come out sometime, I'm hearing, October or November. So we'll see what happens. But a lot of what we're going to talk about today is based on that book and the research that I've done. So let's jump in. And let's start talking about what you're going to learn over the course of the next 30 or 35 or 40 minutes, depending on how long-winded I get. You're going to learn about the economic impact of this financial crisis. We're going to talk about steps you can help to protect yourself, as you see on the screen, how to capitalize if you want to be capitalistic. We're going to talk about the optimal strategies to really reduce the odds about living your retirement savings. And we're going to talk about the biggest mistake that I see retirees make and how to avoid it. And for clients, you've heard a lot of this stuff before. There's a few things in here that we're going to talk a little bit differently. So a lot of this is going to be refresher. For non-clients, this is probably going to be brand new to you. But let's talk about the financial or the possible economic impacts of COVID. It's different than the financial crisis. The financial crisis of 2008 was monetary driven. It was a result of the subprime mortgages crashing, and then to add fuel to that fire, once some of that started coming to light, then we realized that the banks and insurance companies had inextricably tied themselves to each other through credit default swaps and derivatives, and that really just caused a lot of the further decline. But a monetary problem can be solved by money, and that's what the Federal Reserve did, and print money they did, and they continued printing money year after year for 7 or so years after that crisis. But this situation is different. This is not a financial crisis. This is a true economic stoppage. Businesses are closed down. The travel industry, as you know, has been hurt. Rental cars, the restaurant industry, the hospitality industry with hotels and more than 70% vacancies for the last 4 or 5 months. People are not spending money. And even if they wanted to spend money, the simple fact is that most of the businesses are shut down. they can't spend the money anyway. So anything that you hear out there, anything that you read out there about what's going to happen, what's going to be the final result is just a guess. It makes it very, very, very difficult for analysts to forecast. But the reality is that we can take a look at history and we can make some comparisons. And if we're going to look at history, the two great events that I see being compared out there by analysts and money managers and so on are the financial crisis of 2008 and the Great Depression. And yeah, it's been likened to the Great Depression. So the reality is that there's two considerations when looking or trying to figure out where could this go. One consideration is unemployment. The other consideration is gross domestic product. So let's take a look at both. Let's take a look at unemployment and gross domestic product. And unemployment from mid-March to mid-May 2020, there were over 36 million applications for unemployment. And as of July, there are actually 33 million workers on unemployment. And that makes the official unemployment rate 13.3%. But Jerome Powell, when I listened to him 3 or 4 weeks ago, said that that number was inaccurate. And I knew that number was inaccurate because the math doesn't add up. If you take a look below, there's 330 million people in the country, and there's really about 130 million people that are actually workers. I'm sorry, 200 million workers, 200 million people that are actually workers. There's about 130 million people that are actually retired or over 65 or children. So we can't count those people. So you have 200 million workers and 33 million people that are on unemployment, and you come up with a 16.5% unemployment rate. And that's exactly what Jerome Powell said. He said that the unemployment rate's probably 3 or 4% higher than they're saying. Now, interestingly enough, some of you may remember that it was about 3 weeks ago or so where the unemployment number came out, and it went from 14.6 to 13.3. And the market went up by 3% that day, by 3%. Why? Because the market is expectationary. It's not that it went up by 3% because 13.3 is a phenomenal unemployment rate. But the fact is that if the market expects that the unemployment rate is going to be 14.6 and it comes in better than that, then that's a reason to cheer. That's not a reason to cheer. The stock market is completely out of touch with reality right now with regards to unemployment, and as you'll see, with regards to GDP in a minute as well too. But the true unemployment rate is really 16.5%, and I've heard people even talk about the fact that it's closer to 20% as the official unemployment rate. Because this doesn't include workers that went back part-time, maybe they're not working full-time, they're working part-time. It doesn't include those people at all. But there's more to the story. And that is that there are a lot of people out there that are working for companies that got payroll protection loans. The government put, I think it was 750 or 800 billion dollars to businesses for payroll. And as long as most of those funds were used for employees, then the reality is that that money would be forgiven. And so what's happened is you've got a lot of businesses out there today that have taken that money that are paying their employees to sit at home. Completely legal, completely above board. There's no issue with that at all. That's what the government said, but they're paying their employees to sit home. And I don't know the ins and outs of that. I know that they've made several changes, but initially it was an 8-week program. You got to pay your employees for 8 weeks. And then after that, that was it. And what we do know, though, is that 8 weeks, I think we're in week number 9 at this point, where now all of a sudden the employers are starting to run out of money, and all the employees that have been being paid to stay at home are no longer going to get paid because they're going to get terminated. And what was a temporary layoff is going to turn into a permanent layoff. And the sad reality is that unemployment number is going to go through the roof because all these people are now going to get unemployed, unless the government does something else. And right now, I believe that people are feeling like the Federal Reserve has your back, which is why the stock market is as high as it is. Has nothing to do with fundamentals. So those payroll protection loans are running out, and it's already been predicted that unemployment could go as high as 30%. even though it's less than half of that right now officially. So what about GDP? Gross domestic product is the measure of how well a country's doing, right? And a typical GDP, a good GDP, really is anywhere, around 3 to 4%. Even 2 to 4% on the low side is where is where GDP should be. That's healthy for a country. And the Federal Reserve has been fighting to get to 2% GDP for the last dozen years, ever since the financial crisis. So if you were to get a 2% raise in your paycheck, then you had a GDP of 2%. If the country has 2% growth, then the country has a 2% GDP. That's a 2% growth in GDP. Well, the predictions in May came out that GDP for the second quarter might be as low as 34% to 38%. As you see on the screen, Goldman Sachs has said they predicted that it could be as low as 34. Morgan Stanley said 38%. The Atlanta Federal Reserve just a few weeks ago said that it could be as high as 50%, 50% GDP. Negative, that is. That's a negative 50% GDP in the second quarter. Well, the number just came out this morning. And that actual number was 32.9%. And I was actually surprised that the market didn't go up because it wasn't as bad as maybe it's been predicted. It wasn't the 34, it wasn't the 38, it certainly wasn't the 52. 32.9% contraction in the economy for Q2, that's phenomenal, right? Markets should go up. That's not phenomenal. But the reality is, though, is that it was better than expected. But the market didn't go up, went down a couple hundred points. Why? Well, because now Congress is fighting about the new loans, and they're fighting about extending unemployment, and they're fighting about the new business loans and what they're going to do to carry us forward, because the virus is now, moved forward and started to lock itself in again, and started to increase in different states like California. So really, it's a combination of those two things is why the market didn't go up more. But these GDP predictions are horrible. 32.9%, that's the biggest one quarter loss ever in the United States, in United States history. And yet the market is really at this point only 5% off of its all-time highs. It doesn't make any sense. And for some of you that watch my video, I put out 5 or 6 videos in the last probably 3 months trying to keep you informed. And for those of you that have subscribed to our YouTube channel, the moment I put it out, you get that subscription immediately. We send it out newsletter. So if you're on our newsletter list, then we send it out newsletter, and you'll get it, maybe a day or two later. But if you haven't subscribed to us, go to our homepage, Providence Financial Inc., and click on the YouTube button and subscribe. And then the moment I put it out, you'll just get it faster than if you were to wait to receive our newsletter. But I've talked about this in one of my videos that the market is completely disconnected from reality. And I got that. Literally, it just doesn't make sense. Why is the market only 5% off of our all-time highs? Because the GDP numbers don't support that in any way, shape, or form, and unemployment numbers don't support that in any way, shape, or form. It shouldn't be there. But again, the answer is the Federal Reserve. They talk about don't fight the Fed, and that's exactly what's happening. My concern is that the Federal Reserve can only hold on for so long. That's the bottom line. They can't starve off or stave off a crash forever. What goes up in the world of investments must come down. But let's then take this information. Let's take the unemployment information, and let's take the GDP information, and let's compare it. Let's compare it to history. Let's compare it to 2008, and let's compare it to the Great Recession that started in 29 and went all the way until 1933. Let's compare it and see what the end result of the stock market was as a result of negative GDP and as a result of negative unemployment. And I'm gonna, I have this chart in my book. In the afterwards, this exact chart is there. And what I do is I explain the chart. So instead of me explaining it, you guys look at the chart, you guys assimilate that, and I'm gonna read the chapter from my book, not the chapter. I'm gonna read probably 2 or 3 minute segment from my book of how in my book I explain it, because in my book, it's very well worded, if I must say so myself. So better than I can word it. Now, let me read this part of my book, and you guys follow along. I quote, in 2008, GDP reached minus 4.3%. In 1930, it got crushed by negative 30% between 1929 and 1933. In April 2020, Goldman Sachs forecasts an unfathomable loss of 34% GDP, while Morgan Stanley predicted a whopping minus 38%. If either of these come true, and I hope they don't, it will be worse than the thrashing that the US suffered during the Great Depression. Regarding unemployment, the highest it ever got during the financial crisis was 10%. During the Great Depression, it reached a nosebleed level of 25%. Presently, unemployment is at 20% or worse, and that's the good news. The Federal Reserve Bank of St. Louis has forecast that unemployment could reach as high as 30%. The unemployment rate has already doubled that which occurred in the 2008 financial crisis. And if the Federal Reserve Bank's forecast proves accurate, then the unemployment will eclipse that of the Great Depression. So what impact has all of this had on the stock markets? Well, in 2008, the market slid by 56%. And in 1930, the free fall was a tad shy of 90%. We don't know what is the final outcome of our current stock market, but we can certainly make some educated guesses. The GDP and unemployment data are already more than twice as bad as that which occurred in 2008 when the market slid by 56%. Simple question. Should our current stock market do better or worse based on the fact that GDP and unemployment is twice as bad? If you said worse, you've been paying attention. And if the economic forecasts of record-breaking unemployment and negative GDP actually come true and prove to be worse than in the Great Depression, is there any reason that our stock market could not snowball as much as 90% as it did in 1929? Now, to be clear, I'm not saying that it will do worse, but we cannot say that it's impossible. I don't want to think about this happening any more than you do, but we have to admit that it's possible. The S&P 500 reached a high of 3386 on February 19, 2020, and ran off a cliff to 2237 by March 23rd, a chilling drop of 33% in 33 days, by far the fastest decline ever in the shortest period of time of United States history. The Dow Jones declined even further by around 37%. But then the markets rebounded, and now only about 5% off of their all-time highs. In a CNBC interview, Howard Marks, the billionaire founder of Oaktree Capital, spoke about what he sees as a huge disconnect between what the coronavirus pandemic is doing on the global economy and what we're seeing in the stock market. He quipped, "We're only down about 15% from our all-time highs of February 19th. It seems to me like the world is a whole lot more than 15% screwed up." He further commented, "It took 7 years to get back to the 2000 highs in 2007. It took 5.5 years to get back to the 2007 highs in late 2012. So is it really appropriate that, given all the bad news in the world today, we should get back to the highs in only 3 months? That seems inappropriately positive." I concur, as do many other experts. End quote. Again, I'm not saying that this is going to happen. What I am saying is we can't say that it won't. And you know, as my clients, you know that my philosophy is this: plan for the worst case scenario. If you plan for the worst case scenario and you are prepared for it, you'll be just fine. But if you plan for the best case scenario, you could get crushed. You could get hurt. And I just don't want that. We all know people that in 2008 wanted to retire in 2009 and 10 and 11 that couldn't. I have a client in 2008 that lost half her portfolio, 2007 that lost half her portfolio by 2008 and was suicidal. So the reality is we don't want that, and I don't want you thinking that it couldn't happen again. And I hope that this doesn't happen any more than you do. But we have to admit it's possible. So prepare for it. Right? And this is one of the conversations that we have in my office all the time. How do we prepare for it? How do we prepare for the worst? What do we do? And the answer is going to be different depending on your assets and your net worth and what you're trying to accomplish, what phase of life you're in. You're certainly different than if you're 30 or 40 years old, and if you're in retirement, you're 60 or 70 years old. There's a different way of preparing for it. But the reality is we have to be prepared. And when you look at investments, investments can be categorized either as income producing investments or growth producing investments. And if you're a client of mine, you've seen this before, because this is a financial equation that I talk a lot about. Okay, TR, total return, equals I plus G. And when you look at G and I, growth and income, they're two different strategies of investing your money. And when we talk about the G part, what we mean is capital appreciation. Buy low and sell high, right? And you might make a lot of money, you might lose a lot of money. There's certainly going to be a lot of volatility. But the reality is the performance of your portfolio when you're invested for G, for the growth, is dependent on the share price. And if you're retired and you're taking money out of a growth-oriented portfolio, there's only one way to do it, and that is you have to sell shares. If you have mutual funds, you got to sell shares. Unless you can live on 1%, you might have a 1% yield in there that you can live off of. But most of my clients, most people can't live off 1%. They need 3, 4, 5%. And if you need that kind of return, you have to sell shares. And so what that means is that you're cannibalizing your portfolio. And if you live long enough, you're going to spend all the money. And investing for growth, investing in the stock market, investing in mutual funds is a phenomenal strategy when you're dollar cost averaging, when you're putting money in. But it's a horrible strategy for taking money out because you have to sell shares. Now, if you're younger, being invested for growth and being invested in the stock market still makes a lot of sense. Don't mishear me. I think it makes sense to be invested for growth for the long run. But there's then a question of how do we do that? I had a conversation with someone earlier today that was doing really well. Might even be on this call. I was impressed. But the bottom line is that this individual was concerned. They were conservative. I believe they were 40 years old, early 40s, and they could afford to ride out the next 20 years. And there's a lot of people and a lot of advice that is just hang in and ride it out. Well, in 20 years, you'll probably be glad you did that. But if we think that some of this scenarios that we're talking about could happen, even if it's not worst case scenario, and I hope it's not, and I'm not predicting for the worst case scenario, so please don't hear me wrong. I'm just talking about what is the worst case scenario. But we do believe that the market's got some problems ahead. Most people believe that. And if you believe that the market has some problems ahead, then if you're younger, then you don't have to just write it out. Wall Street wants you to just write it out. That's what they're going to tell you. Why? Because it's easier for the advisors. They don't have to do some trading. They don't have to do anything. But if you think the market's going to go down, no matter what age you are, maybe it's time to take some winnings off the table and wait for a better opportunity. Is there risk to do that? Of course there's risk to do that. We don't know for sure that the market's going to come down. I mean, that's likely. I think all the odds are in the favor of the market coming down, but can we say for sure? We can't. That's the problem. But if you want to play with the odds, and maybe it makes sense to sell some now and put some money on the sidelines, either in cash or in income producing investments, and collect your 4 or 5% a year, so at least you're not losing ground, and then get back in at a later point, whether that later point is 6 months from now or whether it's 2 or 3 years from now. We don't know. But if you're more conservative than that, or you're retired, or you're already taking income from your portfolio, then being invested for the G is probably not the right way to go because you have to sell shares. So being invested for the I, when you're focused on the I, income, what we're talking about is a universe of investments out there that are designed to give you interest and dividends that are going to continue to come in and year out and year in and year out, that you can spend regardless of what happens with the stock market. As long as these companies don't go bankrupt, then your portfolio is going to be fine. And so we've got you diversified, we're really no more than 2% in any one particular investment. So even if something does go bankrupt, and you can never say never, we've never had it happen, but even if somebody does go bankrupt, maybe you lose 6 months of interest. It's certainly not going to devastate you. But the whole point of investing for I is to focus on investments that are going to give you interest and dividends. And the interest and dividends are a renewable resource. They're going to come in year after year. Let's take a CD, for example, very simple investment, right? You have a CD, you put $1 million in a CD. If you're getting 4% on that CD, then you're going to be getting $40,000 a year. If you spend that $40,000 this year, guess what? That $40,000, it's going to be there again next year. So you can live on that $40,000. You can spend that $40,000. If you're invested in mutual funds and you want $40,000, you're going to have less shares next year than you have this year. So when you're taking income from your portfolio, you want to focus on the I, get the interest and dividends from whatever investments are that are going to give them to you so that you can live off of them. Now, I can hear some of you now going, give me that 4% CD. Where's the 4% CD? No, there's no 4% CD. That's the bad news. But there's as many as 10 different investments that work like CDs. If you kind of understand that concept, there's a whole universe of investments that work like that. And our goal for you as our clients is to get you between 4.5% and 5% a year of income. Your portfolio is going to fluctuate, but your income is going to remain consistent. Okay, your income's going to, and if you're spending your income and you don't have to sell shares, then how much does that fluctuation affect you? The answer, it doesn't. It doesn't affect you at all, and that's the key. As a matter of fact, I'll go one step further. If you're invested for income and you're not living off your income, then the best thing that can happen for you is for your portfolio to drop in value. And I know what you're thinking, like, what? Why is that the best thing? I want my portfolio to grow. Of course, we want our portfolio to grow. But if you're not spending the interest and dividends, then we're going to be reinvesting them. And if we reinvest your interest and dividends, here's a silly question. You want us to reinvest them while prices are high or when prices are low? Of course, when prices are low. So in order for us to reinvest when prices are low, prices have to come down. When prices come down, your portfolio comes down. If your portfolio comes down, that's because the share prices have come down. So now when we reinvest, you're actually getting them on sale. So when it comes back, guess what? You come out smelling like a rose because we got everything on discount. But it's counterintuitive. You don't want to think about, you don't want the price to go down, right? Counterintuitive. So, but that's really the best thing that can happen. And in the world of Wall Street, what goes down must come up. It's got to come up at some point. It's not going to stay down there forever. But is this going to happen in 6 months? Does it go down and come back in 6 months or a year or two? No. This is long-term investments. Warren Buffett said something that I think makes a lot of sense. He said that if you can't own a stock for 10 minutes, if you can't own a stock for 10 years, you shouldn't own it for 10 minutes. I agree. What was he saying? He was saying that we're invested for the long run. And the same is true with income. Okay, you're invested for the long term, especially if you're reinvesting. It just takes time for you to be invested. So if you're getting income from your portfolio, then you want to focus on income producing investments so you don't have to sell shares to get that income. And we have a number of retirees that have taken the portfolio and put aside what they need to give them the income. So they might be getting Social Security, the pension, they might be getting rental income, but there's this gap. Maybe they need 10 or 20 or 30 or $100,000 a year extra, depending on your portfolio. Maybe they need that extra income. And what they've done is they've set aside enough of their portfolio to give them that income. And then guess what? If you want to take the other part of your portfolio and invest it for growth, well, if you've got your income set up, then there's no problem with that because you don't need it. If you've got your income set up, then you can let that other part of your portfolio, if you want to be opportunistic, you can let that other part of your portfolio be involved or be invested in more risky investments because you've got your income set up. So there's nothing wrong with that. But even still, our equity firm or Sound Income Strategies, the team that manages your money, their equity portfolio is even yielding higher than 4%. So it's still even an income-oriented portfolio, even though there's a growth component and growth potential to it as well. So I think it's important to understand that there's nothing that says that you can't. It's not one or the other. For some of you, it is. Know that even income portfolios went down. There wasn't really anything that was unaffected by what's gone on in the last 3 or 4 months when it comes to liquid type investments. So when we go through this conservative money 101, we talk about the insured items, I often talk about as conservative, and then the moderate items, which I often talk about as being uninsured. And each of you, most of you, have some money in each category. And what's happened in the last few months is there's been a shock. And some of you have called me and said, Anthony, I know when we went through that conservative money 101 tutorial that we wanted some money uninsured, but the market's hit, we're nervous, we're in retirement, we can't afford to lose. Can we take some of that money that we initially wanted uninsured and move it into the insured category? Can we take it from the moderate category and move it to the more conservative insured category? So we've helped a lot of our clients do that. And if you're in that situation and you're watching this webinar and maybe you're wondering the same thing, you're nervous about the market, especially in light of what we've talked about compared to history, then the reality is maybe you want to do that. Let me know. Call the office. Let us know. There's going to be a quick, as I mentioned, a survey. And on that survey, it's going to give you the opportunity to schedule a quick call with me as well. And I'm more than happy to have that conversation with you. Now, if you're not a client of ours, or even if you are a client of ours and you've got money that is more growth oriented, maybe we're managing it, maybe we're not. But a lot of people were shooken up by the stock market in that 33 or 37% drop over that 3 months. And now the market's only 5% off of its all-time highs. And we're getting a lot of phone calls of people saying, look, I went through it once. I kind of told myself, if it gets back to normal, I'm going to change my strategy. I want to get more conservative. And if that's your situation where maybe you're thinking you want to get more conservative, probably not a bad time. The reality is, I believe we're in between rapids. We've come down one rapid. It was a level 5, a category 5. We're in the cool water now, and I think there's more rapids to come. And the worst time to get out is in the middle of a rapid. It's now time, and we've had a couple months of fairly calm water. So the reality is it may be time to make a shift in your portfolio. And if you want me to help you do that, feel free to schedule that 15-minute call at the end of the seminar, and I'm more than happy to do that. Back to income. Let's talk about that for a second very quickly. I want to move on because I want to give you an illustration in a minute here of investing by contract. When you invest for income, you are investing by contract. And you can invest by contract either directly or you can invest by contract indirectly. But the benefit of owning a contract is that you generally get 2 guarantees. You generally get a guaranteed interest rate, and you generally get a guarantee that at some point in the future, called a maturity date, you're going to get all your money back. And when you invest by contract, everything that's contractually related has some kind of maturity date or par value that says that you're going to get your money back at some point, assuming that there are no defaults. And again, that's where diversification becomes very, very important. So you get those 2 guarantees. So the reality is that investing by contract will give you that guaranteed income, and investing by contract also takes you out of the finicky winds of the stock market. So it's usually much more conservative, and it's usually much more stable, and your income keeps coming in and year out. And again, people that like investing by contract are people that want to get the income, they need the income, or people that want to be more conservative. You might be in your 40s or 50s or even 60s or 70s and not need the income, but you don't want to go through the roller coaster ride again. So if you're investing by contract, you smooth out the waters and continue to get that income. So let me talk and give you another example. My clients know that I use a lot of real estate examples because it's just very apropos. There's hardly any times where just a certain example matches what we do so well. So I use a lot of real estate examples, but this example is something that you haven't heard before. Just a new way to try to talk about investing for income because quite frankly, it's a different concept. You've been investing for growth all these years, and now all of a sudden we talk about investing for income. You've never heard this before. So it's different. Trying to tell that story is different. So let's take an example that I think is going to just drive the point home. And we're only a few minutes from wrapping up, and then I'm going to get to your questions, I promise. Let's say that you and I want to buy a piece of property. Okay? And let's say that that property is $200,000. Now, apparently this property is nowhere in California, okay? But let's just say that it's $200,000. And yet, I'm fine with it. I think it's a good time to buy property, but you're not so sure. Okay? You're thinking, maybe properties are too high, and you're not sure if it's the right time. So we make an agreement. And that agreement is this: I'm going to buy the property. I own the property. But you're going to loan me the $100,000. Okay, so we go 50-50. I put $100,000 down payment. I own the property. You loaned me the $100,000 for whatever interest rate we decide. Let's say it's 5%. Right? So now, if the property value goes from 200,000 to 300,000, I'm happy because it doubled my equity, right? But did that have any impact on you? You don't care because you have $100,000 that's due to you and you're getting your 5%. But what happens in the other scenario? What happens if the value of that $200,000, what if the home drops by 50% like they did in '08 and the value is only $100,000? Now I'm miserable because I just lost all my equity. But do you really care? You don't care. Why? Because you continue getting your interest payment. So with regards to that property, I'm a stockholder and you are a bondholder. It's a much more conservative way to invest. Bonds. Now, notice I didn't say bond mutual funds. When you own a bond, you own the contract. You get the guaranteed interest, you get the guaranteed maturity date. When you own a bond mutual fund, you don't own the contract. The legal definition of a bond mutual fund is the stock of a company that invests in bonds. You still have stock, but the underlying value is bond. So you own the contracts indirectly. And the challenge with that is you lose the two most important guarantees that individual bonds give you, namely the guaranteed interest and the guarantee that at some point down the road, you're going to get your principal back. You don't have those guaranteed with bond mutual funds. And yes, bonds is a way of investing by contract. And I only bring bonds up. It's only one example. There's as many as 10 different investments that many of you guys have, my clients, that work like bonds. I often talk about these investments as bonds and bond-like that give you the consistent interest over time and that you can spend and live off of regardless of the value of your portfolio, or that you can reinvest. So the reality is investing for income is really a better way to get the income. So where do we, what's the conclusion? The conclusion of this is I really hope that this worst case scenario stuff doesn't happen. I hope that it doesn't. But if you're prepared for the worst case scenario and it does happen, then you're going to be fine. If you're not prepared for the worst case scenario and it does happen, then you've probably got some problems ahead. Be prepared for the worst case scenario. And if you're not sure what that means to you and your situation, then give us a call. We're going to offer a 15-minute call when you complete that survey. And I would love to get feedback from all of you as to what you think we could be doing better. There's those questions. This is the first time we've done this. We've had an overwhelming response. I'd love to know when you do the survey, if you think we should do more. Would love to know that. So be prepared for the worst. So what I want to do now is I want to do a couple of things. First of all, I need a few minutes to read the questions here and see what kind of questions. I probably don't need a few minutes, but I need to just take a look. I have not been looking at questions as they've been coming in, so I have no idea how many questions we have. I've been focusing on you, but I do want to find out how many clients are here versus how many guests are here. So I'm putting a poll up. And go ahead and just answer the question. Take 10 seconds. I want to know what ratio of you are clients versus guests. Simple yes or no answer. Please go ahead and answer that. I'll give you 9 more seconds to answer the question, and I'm going to close it. And perfect. Still 75%. Getting there. A few people. Come on. These are people that have stepped away. 76, 3, 2, 1, half. Close poll. There we are. So what do we have? Can I share this with you? I can. So there we go. So 73% of you are clients. And thank you again for your business and for your trust. So now let me go ahead and take a look at our questions. And I just may have another poll for you as well, but not now. Let me look at the questions and see how many questions have come through. And how do I access my questions? There we go. Well, there's not as many questions as I would have thought. So feel free to type in your questions. But let me start here. Okay, good question. So what is your opinion regarding the economic outcome of the presidential election, depending if Trump or Biden wins? It's a great question. The reality is, I think if Biden wins, we know the taxes are going to go up. They've already said that. That's not going to be good for the economy. There's been some economists out there that have said that have predicted that the stock market goes down as much as 20% the next day. I don't know that that's necessarily true, but the reality is I don't think that it necessarily matters who wins. And what I mean by that is the federal balance sheet has gotten so out of hand at this point, and the stock market is so out of touch with reality that I think that there's going to be a correction no matter who wins with regards to that. The stock market can't keep going up with unemployment figures the way that they are, with GDP figures the way that they are. And really, the economists out there have basically suggested that you just ignore Q2. I've read that. Just pretend that it doesn't exist. So, and that's what's happened. The world and investors have just pretended that it hasn't existed. Well, you can't pretend that it doesn't exist. It does exist. And there was a 32.9%, I think they said, drop in GDP over the quarter. But now we're looking at Q3 and Q4. And I'm expecting that Q3 and Q4 are going to be bad. And ultimately, I think that's going to have a negative impact on the stock market, no matter who wins. Now, one of my clients said something a few weeks ago. I don't remember who, but one of my clients said something I thought was pretty funny, and I've actually heard other people say it since. But that is that if Biden wins, then this whole coronavirus thing goes away the next day. And I thought that was pretty funny. I don't know how true that is, but you know, I'm not going to get into politics. So, good question. Hope I answered your question as far as that's concerned. Let me keep going. Let's see. What are the questions? Yes, absolutely. Someone noted that the 32.9% is annualized. Absolutely. It is a little bit over 8% for the quarter. 100%. Absolutely true. But 32.9% annualized is still huge when you look at what the annualized numbers were for 2008 and you look at the annualized numbers for, in fact, for the Great Depression. So absolutely, that's a good point. FANG stocks are doing well due to the online nature of the business models. They make up $5 trillion in market cap, and thus the influence on the S&P 500 and Nasdaq. 100%. Nasdaq is at record levels, right? And part of the reason why the S&P 500 is only down about 5% is because you got this big group of tech stocks that are driving up the stock price. I haven't actually looked. I've read articles, and I haven't actually done the research myself, but an article that I read the other day had to do with the fact that I think they said something like more than 50% of the companies inside the S&P 500, the stocks are still down 20%. And I wouldn't doubt that to be true at all because the FANG stocks are, in fact, holding up the stock market. Absolutely. Let me keep going and look at some other questions. How do you think the government will cover the costs of stimulant payments and the loans and the bailouts by future taxes increases, or sell ownership of America to foreign countries, or just let high inflation erode the debt? Good question. There's only two ways that they can come up with cash, and that's the same thing that for any household or for any family. There's only two ways that you can pay off debt. You've either got to make more money or you got to decrease your expenses. In the government's world, making more money is increasing taxes. In the government's world, paying off decreasing expenses means lowering your benefits. And we're going to see some of that for sure. Right now, the United States is at 116% GDP, and that's predicted to go up. Let me back up. 116% debt to GDP ratio. What does that mean? What's that mean in reality? What that means is that the government actually has 16% more debt than the annual income that they take in. Let me bring that down to earth because we're talking about big numbers when it comes to the government. And in my book, by the way, I go through this and I go through the numbers and I give you the example I'm going to give you now. So here's a foretaste of the last chapter of my book. But what does that mean? Let's put this in English. You make $100,000 a year, let's just say. Okay, you make $100,000 a year, but you have $116,000 on credit card debt. How on earth are you going to pay your $116,000 on credit card debt if you're living on your $100,000? It's not really realistic. You have to find a way to increase your income or decrease your expenses so you've got that buffer so that now you can pay down your credit card. No buffer, no pay down, right? It doesn't work that way. But if you have $116,000 of credit card debt and $100,000 of income, you have 116% debt to GDP ratio. That's where the government is right now. They have 116% debt to GDP ratio because of all the debt they've gone into, and they expect it to go higher. Now, let's carry your example one step further. You're making 100 grand a year. You got credit cards of $116,000, right? But you lose your job. You lose your income. Now, is there really any way that you're actually ever going to get it, pay that credit card off? There's no way. And the government just lost their income, right? The government lost a ton of revenue and taxes because businesses that go out of business have a hard time paying their taxes. Revenue is very, very down at this point, and a $4 trillion budget is now $7 trillion. A deficit, a balance sheet rather, $4 trillion balance sheet is now $7 trillion balance sheet. So the reality is that there's only two ways that they can pay off this debt: increase taxes, increase revenue, or decrease expenses, which in government terms is benefits, decrease benefits. And you're going to see a lot of that. And unfortunately, I think it's going to hit hard. Let me keep going. Gold and silver. We have a question about gold and silver. What do I think about it? I'm not a big fan of gold and silver. I have a little bit. And if you want to have a small percentage of your portfolio, fine. But the reality is it doesn't give you income, and it's strictly a growth item. I know they're both up. But the reality is that gold has this long track record of staying at a certain level for many, many years. Gold, I'm trying to remember the history of it, but gold back in the 70s, I want to say, hit somewhere in the range of $700-800 an ounce. And then by the early 80s, it was at like $300 an ounce. And gold will tend to stay at a level for 20 years before going up. So I don't mind someone having it in their portfolio, but very small percentage. It's not something that we would recommend for a large percentage. I'm getting some questions that you guys can't hear me. All right, can you guys hear me? Just someone type in yes or no. Let me see if you guys can hear me, because some people have said that they couldn't. You can hear me. Okay, great. So let me shift back to some questions. We'll answer some more questions. And the nice thing about doing this on a webinar, instead of a live audience, is I can be here all night and answer your questions. I don't plan on doing that, but you guys, if you're done, you have your questions answered, you guys can certainly log off anytime you want. I'll answer the questions as we can. So let's take a look and see what else we have here. So one of the questions has to do with the portfolios that we're managing, the fact that they've fluctuated up and fluctuated down, and a lot of your portfolios are down at this point. And the question is, can we still take income? The answer is yes, absolutely. You can still take income. Think about this bond for a second. And if you understand the bond, you understand how your portfolio is going to work, even though you have investments that are other than bonds. But if you buy a bond for $100,000 and you get $5,000 a year on that bond, $5,000 a year, that bond itself is going to fluctuate. Might go down to 80, might go up to 120, but the 5,000 a year stays the same. So if you want to take your $5,000 a year and spend it, you can do that. It doesn't affect the value of the bond. It's almost like a rental property. If you buy a rental property and you're living off the rent, who cares what the value of the rental property is? As long as that rent's on time, then you can spend the rent, and it doesn't matter what the rental value is, because you're not selling the property to get the income. If you have stock and you have to sell your stock to get the income, then the fact that it's down is a big deal. But if you're living off the rent, the fact that it's down is not a big deal at all. So yes, the answer is, with your portfolios, if you want income, even though a lot of our clients' portfolios are down for the nature of what's going on, you can still get your income. And again, if you don't need the income, the nice thing is you can reinvest it at a lower price. So great question. Let me keep going. Matter of fact, I want to launch another poll real quick here while I'm looking at my questions. Just want to get your feedback as what you think, whoever's still on the call, and there's still a lot of you, is what you think the economic impact of COVID will be. I'd love to get your opinions. So go ahead and answer that. And I'm going to keep looking at questions here, and I'm going to give everyone a few minutes to answer that. And just choose the statement that you think is most accurate. It looks like half of you answered. Well, it looks like most of you has answered. Let's give it another 5 seconds, and I've got another good question here that we're going to answer. So let's do 3, 2, choose an answer, 1. We're done. So let's take a look and see what you guys said. All right, so what do we have? The government will protect us. None. Interesting. The market will continue to grow. 1%. The market will remain flat. 4%. So the market's going to have some major problems. Half of you and the other half think it might go into a depression. I agree with you. Unfortunately, I think that's the reality, and we have to be prepared for it. So that's interesting. And thank you for sharing those results. Our next question. Would you recommend annuity contracts? In the right situation, I think they make sense. We focus on people that are retired. Annuities are great to protect your principal and get you guaranteed lifetime income. Now, there are certain annuities that I would never touch. So we have to qualify this answer. But if you can protect your principal and you put your money in an annuity, that's like having cash in the safe. No one in 1929 through that 1933 Great Depression lost any money in an annuity at all. And now they've evolved in such a way to where you could earn anywhere between 3 and 5%, have your money as safe as the bank, and get guaranteed lifetime income without giving up control. So that doesn't mean that the answer is yes, but I'm going to say 75% of our clients that are retired that need income have an annuity somewhere in their portfolio, because I'm a big believer of having money in the bank, money in the safe, something that is guaranteed. I don't like to do retirement guessing. I like to do retirement planning, and I like to have some money that's guaranteed sitting in the safe that you know you can count on no matter what. So in the right situation, I think it makes sense. See what other questions we have here. What's your best guess on when the next set of rapids might occur? Great question. We don't know. I think that the election is going to have a lot to do with it. I think the closer we get to the election, that's going to have something to do with it as well. The fact is that that the market is expectationary, right? The market looks forward to what they think is going to happen. If we get surprised by an election, then the market could go haywire either way, because the market is going to price in what they think is going to happen. If they think Biden is going to win, then the market's going to price that in the closer we get. So as we get information, that's what's going to happen. But I think the election is going to have a big factor on the outcome. I also think that Q3 results and Q4 results are now going to have a big factor as well too. So my crystal ball, I don't know. We can't answer for sure. I think we could have some more of what we've had. I think the market's still going to figure itself out. I think we could even go up a little higher at this point. And we could be in this pattern for another 3 or 4 months. I really don't think we'll get to 2021 without having some major problems. And again, I have to tell you, I have to be clear. There's always someone that will call me back and say, "Well, you think the market's going to go, going to go crazy?" I do, but I got to tell you, we don't know, right? We don't know for sure what's going to happen, and that's why you just have to be prepared for the worst. Let me look at the next question. Yeah, good question. Not in our 40s, so not a lot of time for growth, but not retiring for another 12 to 15 years. Wondering about the balance of investing for income versus investing for growth. So, like, what do we have? Which way do we go? The reality is that's a very personal question. I think everyone's a little bit different. The younger you are, the more risk you can afford to take, and it really depends on how do you want to treat this. Do you want to try to be opportunistic, or do you want to protect your principal? We've got clients that if they earn 4 or 5% on their retirement, they're set for life. They never have to worry about gambling. Why gamble in the market? Why take the risk if you've already won the game of life? At some point in time, it becomes more important to play defense and offense. On the other hand, if you're 40 years old and you're still building your retirement, then I think having a portfolio of stocks and income producing investments is a good way to go. But it depends on you. If you want to be opportunistic and you don't really know what to do right now, a lot of my younger clients have half of their money in the stock market. That way, if the market goes up and we don't have some of these problems, then they can capitalize on that. But they have half their money in other stuff. So if the market goes down, they can capitalize on that. If you're young and you're fully invested in the market and the market goes down, how are you going to capitalize on that? You can't. You have to have cash. You have to have dry powder to be able to load the gun later if the market goes down. And for you clients, you know that we've got a lot of cash in your portfolios at this point. because we're waiting to load the gun. Most of our clients have between 15 and as high as 30% cash waiting for the next set of rapids to occur. So good question, but it's really a personal question. Let me keep going. Thank you for the questions, by the way. Thank you, Dennis. Appreciate the comment. A lot of these questions are just really personal. So I'm just going to invite you, instead of me answering the question here, to invite you to call us. I'm really looking for questions that I think are just beneficial. Someone said, give us example of other contract track-like investments. There's different flavors of bonds. There's muni bonds, which are not our favorite right now. There's different flavors of corporate bonds. There's preferred stocks. There's real estate investment trusts. There's business development companies. There are annuities, fixed or index annuities like we talked about. So there's some other examples of income-oriented investments as well also. And some of these questions, by the way, I've answered. And Brad, again, your question is really personal, so prefer to hit that. Just call us and we'll certainly talk about that. I know we just spoke recently as well too. What is the name of my book? You think I would know that answer? It is, we went through a lot of titles. I'm trying to actually remember what title it settled on. We settled on, maybe that's embarrassing to not know the name of my book. I don't remember, but it's on our website. And we'll be promoting it soon. I'll be doing a lot of TV interviews soon. Okay, good. I think that's it. I think that's it. So I don't see any other questions. If I missed your question, I'm so sorry. It's been an hour on the dot since we started. We are going to replay this again. And I'm not sure exactly how we're going to do that, whether we'll put it out on Facebook or whether we will put it on YouTube. I'm not sure. But at some point, I think in the next week, it'll be available. You'll probably get a newsletter in your an email from us letting you know that it's available. And at that point, you're welcome to go back and watch it again. When you're finished, when you click off at this point, please complete that survey. If you want to schedule that 15-minute call with us, just let us know that and click that, and someone from my staff will be in touch with you in the next couple of days. But I appreciate your business. I appreciate your trust. Thank you for my clients, and call me if you need anything. God bless.